Hey, good morning, everyone. Chris Lopez here, and welcome to our third webinar in the Portfolio Analysis Mastermind 2.0. Now, before we jump into fun stuff, I have to give you the quick disclaimer that the stuff we're talking about is for educational and illustrative purposes. We're not CPAs, we're not lawyers, we're not certified financial planners. So take our advice with a grain of salt and go out there and make sure you talk with your team of professionals. If you need any recommendations, please reach out to us. We're happy to pass you along some names. But moving on, the whole purpose of this mastermind, the end goal is to get people understanding some key concepts, what it takes to go out there and build wealth in real estate, which is the optimizing of your equity, the reoptimizing of your equity. I'm going to walk you through some examples and help you get a handle on your own portfolio and understand what you can do out there to meet your goals. And so today we're going to follow along what we did like last week. We're going to do some quick intro stuff, and then we got a couple portfolio analyses. Jenny's going to do the first one. She has to hop off at 11:30, and then Lon's got a couple analyses to go over as well. And one of them is actually one of Nicole's properties, so it'll be a fun webinar. So give us our official introductions. You got me, Chris Lopez, Lon Welsh with Ironton. Good morning, Lon.
Morning.
And we got Jenny Bayless with Envision Advisors. What's up, Jenny?
Good morning, Chris.
Morning. And then, last but not least, is Nicole Ruth. Good morning, Nicole. How are you?
Good morning. Doing really good.
Glad to have you. And our fifth panelist, Aaron, is in Mexico this week, so he is watching us from the beach with a drink in his hand, I hope. And we got our webinars. This is our third one. And make sure you're plugged in the resources here. And we'll move forward to the one I think most people are interested in, and that is our free portfolio analysis session. We mentioned this last week on the call, and this is for everyone that's plugging their properties to the software and attending these webinars. We don't have lots of questions. So we are attempting to do a free 30-minute portfolio analysis with anyone that wants to come through it. Now, the in-depth of this will be obviously limited by the time, but in that 30 minutes, we can hopefully give you a really good overview about your portfolio, some options, some ideas, and give you some action steps to go out there and do more work with your team, our team, invest with us, whatever fits you. I want to give you that high-level education. And if you need more one-on-one help, we can discuss that. We are starting to do some testing with some paid advisory. We know some people that need want a lot more help or a lot more models. So if you want a lot more help, we can talk about that in the call and talk about some ongoing advisory from Jenny, Aaron, myself, if that's something you're interested in. But to keep it simple and to give you value, you want to do a free 30-minute session. So you can scan the QR code, and I also drop that link in the chat here in a few minutes. But we would love to talk with everyone. If you schedule, come with me, Jenny, or Aaron. And then one other thing I'll mention, because last week Lon started using some examples on passive investing, specifically from the National Diversified Fund from Ironton Capital. Had lots of people ask questions on there. Didn't have time to go into details on there. But next Monday at 3:30, Lon and myself are hosting a webinar. That'll be an intro to passive investing and some Ironton Capital stuff with National Diversified Fund for growth and short-term income for income fund. So if you want to check that out, we'd love to go into a deep dive on there. And that's just for PAM attendees and PAM registrants. So click the link, and I'll put that link in the chat box as well to register. Can't make it live, register, and you'll get the recording like you do with all the other webinars. Oh, a question here on the PA sessions. And Jenny, why don't you start taking over the slides? We'll answer a question. Monique says, will you be able to see our portfolio, or do we need to share it with you somehow? Great question, Monique. We can see your portfolio. We have an admin view in there. So as long as your property is loaded in there, nothing on your end, just make sure they're loaded in there and we are good to go. We can pull it up while we're on that Google call together. So I'm going to hand it over to Jenny now to go over the first portfolio. Good morning, Jenny.
Good morning. I'm excited to go over this investor's portfolio because I think that it's a really good example of, your goals might actually be achieved right under your nose, and you might not even know it. And I think that this is a really good example of how Property Llama as a software is able to give you that view and make things easier for you when you start to understand and analyze your situation. So we will go into our first investor's situation right now. And again, this is our 5-step framework that we've been discussing over the last couple of weeks. And so we will take it one step at a time. So our first investor's goals is he's actually in the cash flow phase or the consolidation phase. So he's income focused and not growth focused. He is aiming to retire. He's partially retired, and then also his wife has been able to retire from his current property's cash flow, which is, I think, phenomenal. So they have a family goal of retiring with $100,000 in cash flow from a yearly basis in the next 5 years. So I think that's a very achievable goal. And actually, I think that he can do it sooner than he thinks. So step 2 is have a holistic view of your portfolio. Going into his active real estate, he has 8 rentals. 6 are paid off Denver rentals. 1 is a mortgaged Denver rental, and 1 is a mortgaged California rental. He also has a primary residence. And again, we don't treat that as an investment opportunity, or excuse me, as an investment property, but it can be an opportunity to utilize your equity. And then passive real estate. He does not have any passive real estate yet, but he, possibly is interested in a syndication or fund opportunity as well. So going into his active real estate portfolio, really the key features that we want you to focus your attention to is that right now he has $85,000 in yearly cash flow. And again, his goal was $100,000 in yearly cash flow. He has total NOI of about $121,000 because he has those couple of leveraged properties. So this is his primary home. Just wanted to give you a snapshot. He does have a good amount of equity in this property. However, we're actually not going to tap into it in this situation. So it's there. It's there if he needs it, but we can actually work within his current rental properties to make him achieve his goals.
And this makes sense because he's not in the accumulation phase anymore. He's in the going in the retirement phase. So de-risk and de-leverage is the common theme there.
Exactly. Yep. And he does have a 401k, but again, nothing in passive real estate at this point. So please don't get overwhelmed by these slides. Really just the purpose is these are 4 of his paid off properties. We just wanted to highlight his equity position as well as his NOI. And again, his NOI equals his cash flow because he's paid these off, which is absolutely an accomplishment. So he has 4 paid off properties on this slide. And then on the following slide, 2 paid off properties. So again, please don't focus on the details. Just know that these are just representative of his 6 paid off rental properties that equate to about $80,000 in annual cash flow. So now he has 2 rental properties with mortgages on them. And as you can see, the California property, he has about $12,000 in annual cash flow that he's getting. And then on his Aurora property, he actually has negative $7,000 in annual cash flow. So between the 2 of these, he gets an additional $5,000 annual cash flow. So now that's why we're at that $85,000 annual cash flow. So what we are seeing right here is, let's go back. Something that is interesting is that this is not a great performer. It's only a 2 cap. We're looking at negative cash flow. There is a good amount of equity in this property. So what we would suggest is looking at this equity position. So he has about $325,000 in equity. And this property in California has a really good NOI, has almost $30,000 a year. So if he were to sell this poorly performing rental property, use the equity after, of course, selling costs and all of that, and pay off his loan balance in California, in one move, he will simplify his portfolio by getting rid of a poor performer and then paying off the loan balance of a good performing asset. And now he has met his $100,000 a year goal. So
Good.
we just
One question.
Go ahead,
This
Chris.
is something I've noticed on sessions on that previous slide, Jenny.
Mhm.
That Aurora property that's a 2% cap rate. I don't understand how a $670,000 property rents for $1,750. Is it really that poor, or is it just really, really, really under market rent?
I've during our sessions, I have seen a combination of the two. A lot of times it's a friends and family discount, or perhaps a long-term tenant that someone has a good relationship with and doesn't want to rock the boat too much. And sometimes we always ask, like, is this market rent? And sometimes they say yes. So it can be a variety of reasons, and there's no right answer. I mean, obviously there's an optimal rent, or which would be market rent, but we understand that there's a variety of reasons why something would be under market value.
Yeah.
For sure. So this is showing the difference between, this is his current portfolio valuation. Again, we're at that 85,000 total cash flow mark. And then after selling that negative cash flowing property, we've actually exceeded our cash flow goal in one move. So that is kind of exciting to me, especially when you think about, when you're at the point in this investor's career, when you want to simplify, I would definitely want to get rid of, a low performing property, have fewer properties on the books because this individual self-manages. So have fewer properties, but have fewer better properties in this case. So again, selling the negative cash flow property, pay off the debt of the high NOI California property, gets our clients to their goals. So here's a little scenario over to the right here. His overall portfolio valuation does go down, but his cash flow goes up. So, that is just something that is interesting to consider, because when you're in your growth phase, you want this valuation to go up. But in this individual's case, he's at the end of his investment career. He just wants to set it and forget it. So he's more focused on this column right here. So what scenarios would you explore?
So one question before we jump into that is, Lynn said, is that total cash flow gross? I believe that's after all expenses and after any mortgage debt, if any, still on there, right?
Yes. So we'll go back to a sample. So for example, just quick eyeball math, $1,000 a month for this property, that would be gross 12,000. NOI is subtracting out his annual expenses and contingencies for maintenance and vacancy. So that's net. His cash flow is net of those.
So I'm curious, before I know what I'm going to say, but I'm more curious to hear from like Lon or Nicole if you guys have any reactions to this.
Well, I think anything with the 2 cap has just got to go.
I would agree.
Yeah, probably anything underneath the 4, you should probably really look at disposing of. It's just, so we can find stuff in the market that's in the 5 to 5.5 range, and it's a little bit of a nuisance to have to sell and buy, but you're going to come out ahead by making that trade.
And I'd just love to add, I love how simple it is to see it. Because it's up to me in the Excel spreadsheets or my husband putting the numbers together. And this does make it really easy. So, and I know that we're going to be going through one of our properties here in a little bit too, but it is nice to see how obvious getting rid of that property is. It's hard to combat kind of the numbers and making that emotional decision to get rid of a property that maybe you spent money on, or maybe you upgraded, or maybe it took some work. And there's some pride of ownership of the fact that you even purchased it, right? We get emotions around some of our investments, but to be able to look at it in black and white is really helpful.
Yeah, and one of the interesting things here, and this portfolio does a great job of showcasing it. And this took me by surprise, but I learned this as, you know, a lot of times for many investors like this, that best move is to sell a property or two, pay off some other ones, and actually increases the cash flow, which is counterintuitive. But a lot of times when investors are going towards a retirement goal, I've seen this model play over and over again. And I think it's a great time to sell some of the not so ideal properties. In that case, that would be that low cap rate in Aurora. California is not a friendly landlord state. So I'd be inclined to move away from both of those and pay off the other properties and then reinvest accordingly to like what this next phase of his career is. Jenny, someone asked about what about capital gains? Doug says, what about capital gains?
Yeah, so he would incur selling costs and he would incur capital gains. I don't believe that he would qualify for the Section 121 exclusion for this. I don't know the details of it. So you would want to bake that in to your net that you're able to walk away with from this Aurora property. He might not have the full $292,000 at the end of it, but you know, he would have to throw in a few dollars to pay that down to zero probably in that case, but it's negligible for the sake of demonstration.
Yeah, and we have some other previous webinars and podcasts where Lon's actually put together some really cool models about showing different scenarios of, hey, doing 1031 to not pay cap or to defer capital gains versus paying it. And depending on what you reinvested into and what phase you're in life, there's a lot of scenarios where it makes sense to pay the capital gains. And since this gentleman is a lot more focused on cash flow, he's probably less concerned about capital gains since he's not looking to grow. He's looking to simplify and increase cash flow is kind of my takeaway. But yeah, definitely that's why you always have to talk with your professional CPA team, which is not us. Cool. All right. So question here from Eric. I'll reply to that, Eric. Yeah, I misread that. Cool. Well, I think that was the questions on here.
Hey, Jenny, what's our return on equity after we make this change? Is it about 100,000 of cash flow on about a $3 million worth of portfolio? 2.4
Yeah, for
million?
$2.5 million. Mm-hmm.
So that's what, 4%, I guess?
Let's see. I can't do math this early.
I'm always terrified to do math live on a webinar.
Yep, 4%.
Got it.
Yep.
So, you know, one other option that they could think about with this case, if it's 4%, is that you could sell the whole portfolio, pay the capital gains, invest in something like the short-term income fund, and it would pay 7 to 8% as opposed to 4%. You'd actually make more cash flow even paying the taxes doing that. It would just be straight income.
And less headache.
Yep.
Great. And what Lon mentioned there for the income fund, like I said, that will go into more detail in that webinar on Monday. So get more details on there. Sorry, Nicole, I cut you off.
No. And I think we'll go through it on Monday. And I'm definitely, so something like that, I would say as an investor, one of the only fears is putting my money in something that has those returns. To what extent are those returns going to be consistent for the length of my retirement, right? I mean, that's the question that I'd like to hear answered on Monday for sure, is because my real estate is consistent. Like I know what it is. It's been there unless it burns down, or obviously you've got insurance and things like that. But so the trade-off sounds fantastic. It's just, what does that mean?
Yeah, it's a great one to explore for sure. I'm looking forward to that for Monday.
Love it.
If you want to give a short answer now, because I think we can shift the slides over to your case studies, Lon. So feel free to shift, and if you can multitask, go for it.
Yeah, probably the answer on that would be to sell one or two of the properties that he owns outright that he's not as fond of, especially the ones that are the lower the cap rates among the group. Invest that in short-term income. Keep the properties that are higher cap rates and the ones that are easier to run, the ones that he thinks has more upside down the road. But to take a blended approach would probably be the answer for that. All right, I'm going to share my screen here. And we're going to go to this. Can you guys see this okay?
Not yet.
Not yet. Oh, there we go.
All right, so you should see passive versus active.
Yep, we see that and a little girl and a dog. So you're good.
Everybody's favorite. So last time we talked a little bit about how interest rates for mortgages are likely to drop, so I won't go through those slides again. What I will talk about, though, is this beautiful fourplex up in Westminster.
So are you moving your
Nicole, do you
slides,
want to talk a
Lon?
little bit about this one? What's
Are
that?
you moving the slides?
Oh gosh, is it not?
It's
Either
showing
you're not
the
moving them
other
or
screen.
it's not. Yeah, it's still showing the intro
You
slide.
know what? Let me try to figure that out here.
Now we see the fourplex.
All right, I'll leave it like that. So Nicole, do you want to give us a little overview on this one?
Yeah, so this is actually the product of one of our our earlier investments. We bought a fourplex in Colorado Springs that we didn't know the area as well. So we had kind of taken a leap of faith, ended up buying a fourplex in Colorado Springs. The area that it was in had a ton of turnover, and we just couldn't get in front of it. So, but it appreciated. So we had sold that singular fourplex and turned around, took the equity, and we bought two fourplexes in Westminster right next to one another. So this is one of those, they're almost identical. They're very similar in numbers, off just a little bit due to vacancies. It's a C-grade property. We have a mild amount of turnover. I wouldn't say every single lease, but it does happen because it's more of an entry-level apartment. Doesn't take a lot of maintenance. And the maintenance is more of just ensuring that everything is working properly and that kind of thing, versus we're not putting granite and high-end appliances in a property like this.
Fantastic. So you bought this, I think it was like about 6 years ago?
We did.
Fantastic. So I ran the analysis as if we were to buy this today, and assumed maybe we'd be buying this for about $850,000. Let's take a look at what that looks like. So if you had the money today to buy this, you'd get about $5,300 of rents. You can see what our different operating expenses are. It's about a 4.8% cap rate. And if we go to the next page, we could see that when I highlight this, can you guys see the highlight I put on the screen?
Yep.
Yes.
The leverage I picked was 55%. And the reason I picked that is that it gave me more than 100% debt cover ratio. So just a quick refresher, if you take the cash flow, which is the rent minus the vacancy, minus the operating expense, that's called net operating income, minus the mortgage payment, there should be a little bit of a positive surplus left over ideally. And the debt cover ratio is just showing you how much surplus you've got. So the higher the debt cover ratio, the more things can go wrong, and financially you can still cover all of it. So I picked a 55% leverage just so that debt cover ratio would have a comfortable margin. And Nicole, I put 6.75% for someone who is buying this today. Is that a safe bet?
Yeah, I mean, with a point or so, you could get down there on an investment property. These are a lot nicer. They've got a lower interest rate when we bought them, but that is.
Oh yeah, you've got a tremendous rate, I'm sure, compared to this. So what you find is that the rate of return on this is about a 10.5% annualized return for this if you were to buy this today on the market. And the other option you might have is you could take that same amount of money, invest it in our passive national diversified fund, you'd get about a 17% return versus the 10.5. So if you don't currently own something, you have cash to deploy, those are the two options we have. Let's look at it from Nicole's point of view as the owner of the property, though. She already owns it. So she's got this amazing, it's like just under 3%.
It
right?
is. Yeah. Now it's a 15-year fixed.
It's a 15. I'm sorry, I put it on 30, but it wouldn't change the answer a whole lot.
Right.
This is a tremendous interest rate, which I wouldn't want to fiddle with a whole lot. So she's got about 400 to go on the loan.
Yeah.
The property's worth about 850. So a lot of equity here, about 450 of equity. And if we do nothing and just let it run as it is, you can see that we're going to have about a 13% rate of return, which is pretty good. So another option is we could take out a HELOC. And I figured if you took 80% of the value of 850 and said 675 would be the most amount of debt in total I would want to carry. If my current debt is 400, how much could I safely borrow on that HELOC? And the answer is about $280,000. So that's what I modeled here. So the cash from the property here has not changed at all. It's exactly the same. The mortgage on the first mortgage, we're not going to fiddle with because it's under 3%. That's a killer rate. And then you can see I've got the mortgage payment on that HELOC below. So my new debt cover ratio is right at 100%. So you'd have to subsidize it a teeny tiny bit the first year, but it wouldn't be a whole lot. And then it's going to be break even or positive cash flow after that. The change here is that before we were looking at about a 13% annual return. Now the property is going to be about a 12% return. So that additional debt service doesn't help us any, but the money that we invest in the passive fund gives us 17. So if we take the blended average, now we're at a 17% return. So 17%, versus the 13% is a nice improvement. The other option is we could just sell the thing off. So if we did that, we'd sell it for $845. We'd have some transaction costs. We'd have some capital gains. And as always, of course, you'd want to talk to your CPA to find out what the capital gains would be for your unique situation. Pay off the mortgage, you have about $350,000 left. And you take that whole $350 and invest with us or put it in the stock market, whatever you wanted to do. So let's see what's the best option. So if we do nothing, the $450,000 of equity we have today will grow to about $1.5 million over the next decade. An amazing amount of growth. It's going to grow 3x. If we keep the property and refinance it, it would grow from 450 to about 2.2 million, which is just about $650,000 more. Or we could sell it outright, and that's better than keeping it as is, but it's not nearly as good as the refi. So if it's not too much of a burden to run it, I would say keep the property, don't sell it, but do a refinance and then invest it. Don't refinance it to the max. Do a little short of the max so that you're not going to get yourself stressed out from a cash flow standpoint. Does that make sense?
It does. It helps a lot. And especially considering, putting it into a time frame is something that I would want to do to say, okay, so if I'm 53 today and I want to be able to have the option, right? I'm sure I won't retire fully in 10 years because it's not in my genetic makeup, but I do want options in 10 years to whether it's work less or to distribute some of the activities that I do on a daily basis to my team more, and then, provide more equity to them for the role that they're taking on. So if that is the case, then making sure that in the 10-year time frame that we can still get the property to a position where it's almost paid off or at least cash flowing, and taking that money and putting it into the capital fund. I mean, that second option definitely sounds like I'm starting to multiply the opportunities, kind of like what, Lon, you were talking about, which it's like I had a V8 moment. I was like, I wish somebody had told this to me. You always figure things out a little late and a little on your own. But when you had said, hey, if your goal is, or your cash flow goals are met with, say, 10 properties, and it's using the example that Jenny was just going through with $100,000 a year, will shoot bigger, shoot for $150,000 a year in income and the rental properties. And then 10 years from now, sell the ones that are producing the worst, pay off the ones that are producing the best, keep them, and you'll have them cash flowing earlier than you would if you just had those singular properties that would meet your goals. This is it's taking advantage of that today in real time. So that is a lesson that I'm going to start telling everybody. It's a winner.
Yeah, Jenny's example is fantastic. I'm really glad she put that together because it shortens the amount of time to retirement by several years by doing that strategy.
Yes.
One thing I'll ask you on, because this is always, there you got the spreadsheet, and it's also kind of realigning with the investor's goals or your goals, Nicole. Now, you would put this on a 15-year note for a reason. I'm assuming is that just to pay it off quicker or lower interest rate? Because part of me says, hey, if you're going for a shorter payoff period, and you pull out equity to reinvest, you might have some goals that don't line up where you pull out more equity, or you trying to pay it off quickly as possible.
100%. And that's immediately where my head goes as far as looking at this model and realigning it for that 10-year mark. Because if we take out some of the equity and we put it into a fund that's getting better rate of returns, depending on if that income that's generated from that alternative fund source makes up the difference of the income that we would make on the rental properties, it is all in alignment. We bought our first property when I was 40 years old, and the goal has always been age 62. And so we put all of our properties on a 30-year fixed, but we would pay them with an amortization that mirrored 62 years old. So the older I was when I bought them, the shorter the amortization, and those numbers had to work for us. Because I didn't look at cap rate. I just simply looked, do the numbers work? And is this in an area that I like and the product that works for me? So this would still have to be in alignment with those goals, which is why we put this on a 15, because we don't. I usually put everything on a 30-year. It allows me to drop my payments back in times of crisis. But this one, the numbers worked out so beautifully. And the interest rate was so good that we were just like, okay, these are the only two properties on a 15. Everything else we own is on a 30.
Okay. Yeah, a sub 3 on a fourplex is insane.
Unbelievable.
So I'm curious, Lon. So kind of taking this example of, where she's got a 10-year time frame, someone pulls out the money, pulls out a couple $100,000 in the second line to go reinvest in like the NDF style fund. How do you kind of match up paying back that over a 10-year payback period to pay off that line of credit? I did not articulate that very well.
No, that's a great question. So the target return for the diversified fund is somewhere between 14 and 20% per year. So let's pretend it's 17 in the middle of that. So if we hold the money for 5 years, which is about our expected horizon, what you'd find is that the $100,000 investment today, 5 years from now, we'd give the 100,000 back plus 119,000 of profit. So what she could decide to do in 5 years is say, hey, the market conditions have changed. I'm going to be getting all this cash back from the liquidation of Fund 6. I'm just going to use that to pay off my HELOC. And I wouldn't be able to pay off my primary mortgage, but I'd be able to make a huge dent in it. And now maybe only got like 5 years to go to pay off that mortgage. So it would accelerate the overall retirement date by quite a bit.
So for like just some like very, back of the napkin, mental math for people planning in this case, I think an easy way would be, hey, around the 5-year mark, have, all the original investment back plus your returns. And of course, some of that will probably go to taxes or whatever, but that should be plenty to pay off the loan balance and probably then some. At that point, plan on paying it off, reinvesting it. But maybe around that 5-year mark, a person can do mental math, say I've got the ability to potentially pay off that second line, assuming everything, of course, goes somewhat according to plan.
Yeah, so let's take a look here. Like the balance on the loan today on the primary is $397, and we're talking about pulling out 280. So if that 280 grows to 280 times 1.2, it's like what, 320 grand is what the profit would be roughly. If we've got 40 grand of taxes due, you'd have 240, 280, 270 after tax. And at that point, your mortgage would probably be 320. You'd be able to pay off the HELOC. You'd be able to pay down the primary mortgage from probably 320 down to like 50 grand. So you'd almost pay it off in 5 years, not quite.
So that's an interesting strategy where I never thought about that angle, but that could actually be a way to, obviously you get a bigger return, but accelerate payoff as well if you want to, or accelerate reinvesting.
Yeah, so you could either do that or you could roll it for another 5 years. Yeah. And if we can double your money again, so if your 280 is now 560, hopefully 5 years from now, we can turn that into like $1.1 million. So after capital gains, maybe you've got like 950. At that point, your mortgage is probably almost paid off on the primary. Your HELOC you'd have to pay off. You probably have $700,000 or $800,000 in cash, and your property would be paid off as well.
Cool. And hopefully everyone out there, if you couldn't follow all that math, don't worry about it. But the concept is that, hey, you should get a big chunk of money back on the funds, by the halfway or 5 year mark. But the key point here is every time you always want to be reevaluating your position, the market, the properties, and in year 2, year 3, year 4, year 5. Let's say year 5 is a big chunk of money comes back. Nicole would sit there and reevaluate her goals, the market conditions, what the investment opportunity is like then as well, and to reinvest it, interest rates. And that always kind of comes back to, like, hey, have a rough plan in place, but realize this is not written in stone, that as the market changes, your lifestyle changes, you'll want to come back and replan and reinvest accordingly.
Right.
No.
So really all this is leverage. So you think about, how do banks make money? They borrow money at 1%, they lend it out at 6%, and they've got this 5% spread. You're basically doing the exact same thing here. If you can borrow money on your HELOC at 7, invest at 17, you've got a 10-point spread. You're doing twice as well as the bank is.
I love it.
Should we do another example? Go ahead.
I think we have no questions in the chat box about this. If I would say, let's move on to the next example.
Super. So this came from one of the investors. They put their property into Property Llama and asked me if I would do it here on the show today. So this is a house in Thornton. You can see it's had like a basic level of renovation, so it's a nice house. It's a 3-bedroom, 2-bath, has its own laundry. We think it'd be worth somewhere between $400 and $450 if we were to buy this today. And it's currently renting out for $2,100 a month, which is pretty close to what we had come up on Rentometer, just a little bit less, but they probably got like an established tenant that they really like there. And you can see that they've had this for a while. So it's about a 2% cash return, which is this cash flow of $7,700 divided by the equity in the property of the $300,000 equity they have to work with. So they bought this at a really good price of $125,000. They did a refinance since 2012 when they bought it, but they're still in at like 35% loan to value. So let's take a look at like what that would look like if we were to buy that today. So if we bought this for $450 and put in our rent at $2,100, we'd have a 3.9 cap rate, which is a little lower than I'd like to see people buy at. I think we're still finding people deals at 5%, aren't we, Chris?
Yeah, especially for single family homes, we're seeing stuff. This is probably more like a 5 cap. I imagine that rent's a little low for a 3-bedroom. But yeah, I would pencil in a 5 cap. Okay,
that makes sense. And if you go back to Rentometer, you can see the range on this is $2,050 to $2,500. So if it was a little bit higher on the rent, that would go a long way to closing that gap. So for this example, I did it one way at 75%, which is probably your maximum leverage. You can actually go as high as 85. That'd probably be a little bit aggressive for this property. So that kind of minimizes our down payment, but you can see that our debt cover ratio is well below 100%. So what I mean by that is the cash flow that we generate in year one is $17,500. Our mortgage payment is $26,000. So we'd have to subsidize the property by $8,800. So you'd have to subsidize a little bit. So you might want to do a little bit less leverage than this. But if you had a good income and were comfortable subsidizing it, then that's, of course, a choice you could make. This investment, if you were to buy today, is about a 9.5 rate of return overall. Okay. So what if we already own this house? So that's the example I want to run now. So I'm basing this on, I've got a loan at 4.9%. I bought this house for $125,000, so it's appreciated really well. I did a refinance a while back, so my mortgage is now $160,000. So my equity in the property is about $300,000. So what I could do is I could take out some of that equity if I wanted to, and I could invest it in the passive fund. So let's take a look at what that would look like. So if I do nothing at all, over the next 5 years, my rate of return is going to be 10.5%. If I get the HELOC, I'll end up with a blended return of 16%. My return on my house will be just a little bit less than it was before because I've got some extra debt. I'll get some really good returns from the passive fund, and the weighted average is about 16%. Or I could sell it. So I could sell it for $450. I'd have some transaction costs. I'd have some capital gains. I have to pay off my current mortgage, and I'd be left with right at $200,000 left over that I could invest. Which option is the best? So if we do nothing, oops, my $290,000 of equity will grow to $780,000. So it's going to more than double in the next 10 years. If I cannot get rid of this thing, if I refinance it, my equity will grow to $1.2 million, which is just about $500,000 better. Or I could sell it, pay the capital gains and invest, and my equity will grow to about $1 million. The best answer here, once again, is to keep the property as long as you're not sick of it. And I put in 8% for property management, so you don't have to manage it yourself. You can have someone else do all that work for you. But all things being equal, the best answer is to keep it with the property manager, refinance the second, keep the great mortgage you've got in place, and then just invest the proceeds from that HELOC. And you come out about $500,000 ahead.
So Seth has a question here. He asked, how are you only netting $7,000 a month at $2,100 a month in rents? I ran in this when I put in one of my rentals. I'm not sure if there's something wrong with the calculator or how numbers are inputted.
Okay, so we've got rent of $2,100. Got a little bit of vacancy loss. So we're netting about $24,000 a year. It looks like our expenses are about $6,500. So our rent minus our expenses leaves us with about $17,500 left over. And our mortgage is how much? Okay. Our mortgage today is $10,000. So if we take the $17,000 of cash flow minus the $10,000, that's probably what's given us this. Where's my property line number? I don't have property line. Here it is. That's where the $7,000 comes from. Does that answer that question?
Yeah, it makes sense to me. And I mean, something else on that, if it might be throwing off people on that spreadsheet where you say unlevered cash flow, that's the same thing as NOI, net operating income. So that's what that is. That first line you was NOI, and then you subtract out your mortgage debt. And yeah, we'll make these slides available. And then Matthew says, Lon, will you share the spreadsheets you're using for the comparisons?
Yeah, we can do that.
You can email us, Matt. We can send it to you. Lon and I were chatting last week. We'll probably do a different webinar and training on there. We want to, I think, update that a little bit to make it a little more robust before we really publicly share it. So happy to share with a couple people right now, but stand by for a few weeks for, I'd say, a better version with some more training on there as well.
Hey, Nicole, what rates are you seeing on HELOCs these days?
I saw that question. So when we're talking about, I mean, the Fed rate's still going up, and the Fed rate is affecting the HELOC. So typically they're, prime plus 1 or prime plus 2. And as the Fed rate goes up, so goes the prime rate. So you might be looking at something around 7% on a primary home. If you're getting a HELOC on an investment, there's only a few banks in town that will do that. And you might be looking at a little bit higher and, of course, a little bit lower loan to value on that.
Nicole, you can help with HELOCs too, can't you?
So we do not HELOCs, we do fixed seconds when they're going to purchase. So to pull money out, in your examples, to pull it out to put it into one of the investments at Ironton, we can't do that. We would do a fixed second, say on an investment property or primary, to then use that as a down payment on another home that we're doing the first loan on as the down payment. So that second would be used to purchase a property that we'd be the lender on. So we can do that, and we do that a lot. And those fixed seconds are at 9% on those properties.
Which makes sense.
Mm-hmm.
Cool. Other questions?
Yeah, so we do have, as Nicole said, there's a few banks around town to do HELOCs and seconds on stand-on loans on investments. Email so we can get you hooked up with them. Peter says, when putting properties in the property llama, should we adjust any of the assumptions like vacancy, repairs, etc.? Yeah, you should. I would say put in like your best assumptions based on your property. Depending on how you know the property, we do have defaults built into there, and they're pretty standard. I think it's like a 5% vacancy, 8% property management. So I'd say pretty standard, default underwritings for that. So we use those rules of thumbs, and they should be defaulted in there. So feel free to adjust those according to like how you underwrite, or if your property has, a lot higher maintenance or is a 120-year-old property, obviously increase reserves on there. But the default should be good to go and tweak as necessary.
Cool. You want to do one more?
Yeah, let's do one more.
All right. So I had one other investor who was kind enough to put all their stuff into Property Llama and was said we could share the example. So this is a Sloan's Lake townhome on Depew. It's a pretty property. It's a nice shape. And this is a 3-bedroom, 2-bath that they bought in 2013 for 130 grand. Those were the days. It's probably worth about 475 now. So the property is paid off, and it's got pretty good cash flow. So let's take a look. If we were just to buy this property today, what would that look like for us? And what you find is that we could get a loan at probably about 7%, and we would put. Oh, I'm sorry. This is the as is. I apologize. I did not do the buy this one today since I've already done 2 of those. So I apologize. This is what the investor situation is right now. They have already got the property, and they asked, what if I got a mortgage on it? Just a small one. Let's say 75 grand to pull out some cash to invest. And the answer is this would be a return of about 8% over a 5-year life per year. So the next option is, what if we got a bigger HELOC and we took out a little bit more money so that we could invest it? And the answer is the property on its own would generate about an 8% annualized return. That investment we make would be about 17.5, and the blended return would be about 15, quite a bit better. Or we could sell it with the transaction costs, capital gains, paying off that little mortgage, and invest the proceeds. So what's our best option with this one? And the answer is do nothing gets us from 400,000 of equity to 878, so more than doubles. Keeping it and doing a refinance to get a HELOC goes to $1.6 million. And in this particular case, just selling it outright is $1.5 million. So the middle option, again, is the best, but it's pretty close. So if you're sick of running it in this particular case, like, you could just sell it and be just about in the same position as you would be if you kept it with the property manager for the next decade. So the best answer today has always been on the refi side, but sometimes it's not as clear-cut an answer as you think. So we'd want to run the numbers for you to find out exactly what your situation is. Oops, Chris, you're muted.
Sorry, I was muted there.
That's right.
It's interesting, kind of, you start noticing patterns as you do a lot of these examples. And, as the market shifts and we're in the new market now, you're going to see new patterns where usually it was sell, trade up, and 1031 was always a way to go. And now for a lot of these situations with, a low LTV and a low first position, it's interesting how the pattern a lot of times is keep, refi, and reinvest seems to be the winner in a lot of these scenarios.
Yeah, the market's always changing. And, what I've definitely noticed in the more than 20 years I've been doing real estate investing in Denver is that any given strategy seems to last for about 2 years, and you have to just kind of pay attention to the market and be flexible.
Is that the life cycle, 2 years?
Seems like it.
So I'm curious what people have, questions have on here. And, I always like to take a step back from, I know a lot of times people can kind of get lost in the weeds when looking at, multiple spreadsheets. It's hard to digest. All these slides will be shared, so you can go them step by step, listen to the recording yourself, and we're always happy to help you figure out the situation. But make sure you understand the concepts here. And it goes back to what Lon talked about earlier, Jenny's talked about, is it's leverage and reinvesting the equity. That equity in your properties is your real estate piggy bank. It's not cash in the bank where it's an easy withdrawal. So you have to break the bank a little bit to, like, get a HELOC, sell it, or second on there to pull some equity out. But that is the key, and then redeploying it to go out there to increase the wealth. And the interesting thing is, don't get fixated on what interest rates are doing, because Lon's running numbers here at 7-8% interest rates, and we're still seeing some great returns. Obviously, you have to be mindful of it, but just because you see higher interest rates doesn't mean, oh, interest rates doubled, there's no more good investing deals out there. No, that's not the case. You just have to adapt your strategy to the marketplace. And obviously, you want to be investing at a higher rate of return than what you're borrowing at. If you're making less money than you're borrowing at, that's not a good situation. But reinvest at a higher rate of return, and that's a big key point here. So stay focused on the concept here, which is taking your equity, and of course, any cash you have, but a lot of people are equity heavy, extracting that equity and going out there and reinvesting it, at least understanding the options so you can see what's best for you, your timeline, your risk tolerance, all that good stuff. Monique says, does a 30-minute PA session go over these scenarios of do nothing, refi plus passive, sell plus passive? Probably won't have time to do it in that detail on there, but we can do some high-level stuff for sure. So yeah, on that, we'll go through some examples on there.
Hey, Jenny, what's a typical 30-minute session with you like?
Great question. So we follow this framework that we've been going over, the 5-step, but we do ask for everyone to come, really prepared, essentially with the goal session or goal section of the 30-minute, because we want to hit the ground running. We want you to already come and say, we want to do X, Y, Z. And that way we're able to tailor our discussion a little bit more. We'll do a very high level overview of the performance on your properties. And then we'll spend the majority of the time talking about options of what you currently have and where you want to get to, and a couple of step-by-step processes of how we would recommend taking the next steps to get to that point.
It seems like with Jenny, it's like really optimizing the portfolio of all of your rentals versus, what I'm looking at is just like, what's the best for just one particular property. So you'll need to have a little bit of both probably, plus a talk with your CPA to come up with the best answer.
Exactly. Yep. It's just really planting the seeds for your next steps and just kind of brainstorming some ideas of how to meet your goals.
So Jeff asked, if you're self-managing, what is your favorite property management software? I mean, I don't self-manage.
I don't either.
Yeah.
Nicole, what do you use?
I don't self-manage.
I'll step in. I'm the lone self-manager here, I guess. I use apartments.com, but I'm actually kind of in the process of looking at some of these more automated tools, kind of like sunk costs at this point. I've been in it for 5-6 years for Cozy, and then it became apartments.com. But I'm looking at Rent Ready because it has a maintenance concierge aspect to it, which is probably the most annoying part of self-managing in my opinion. So just something to look into.
And you see a bunch of people put in some, Rent Ready, Avail, Zillow, Doorlop, Quicken. There's a bunch of apps out there. So, I mean, test a few, see what you like. So Peter asked a great question here. Panel, if you can buy with a 5% cap rate, but borrow at 7%, how do you make it work unless you're feeding it or putting down a large down payment where you're or putting down a large down payment? Well, that's it right there. That's what I was showing with those lower DSCR ratios.
Yeah, that's the challenge that we've got, is that at the moment, if you've got a couple $100,000, you'd normally want to say, well, I want to go buy a property and put 20 or 25% down. It's not going to cash flow like it would have a couple of years ago. So at the moment, you can actually make more money with passive investing than you can being an active investor, which is totally not intuitive. It's just the phase of the market we're in right now. So we have a lot of guys investing with us that their plan is just to keep the money with us for several years as soon as we can give the money back to them, they're going to reevaluate the market. And my guess is that at that point, it'll make sense for them to go buy a single family or a duplex again, like historically it does. But just at the moment, it's just a different best answer.
Yeah. And I mean, Jenny and I, when we do a lot of our default underwriting now, I mean, we've always just kind of defaulted 25% for investments, and now our default's 35%. Because otherwise, I mean, pretty much any property, exactly what you're saying, Peter, that's the case where if you put down 25%, it's going to be, for the most part, a negative cash flow property, unless it's a very high cap rate property that's like a short-term rental or a room-by-room rental. But a lot of investors, don't want to own properties like that. Linda says, thanks for sharing the comparisons. Thank you for going into detail. Class is great. You're very welcome. We love doing this. So I think that's all the questions we have on here, and we're right at the hour mark. So I'll start wrapping things up. So if you guys have any last minute questions, put it in there. Otherwise, key points are, look at the conceptual stuff we talked about, which is leverage and putting your equity to work, and then being mindful of how that plays out and aligning with your goals. And, our goal with those 30-minute one-on-one PA sessions help you figure out a lot of that stuff. So make sure you do go schedule that. Me, Aaron, and Jenny are very excited to do those. So make sure you schedule those. Next, we have a couple webinars. We have the Tuesday webinar, and that's all about depreciation. And it is a fascinating aspect to real estate investing. So make sure you plug in that or catch recording. We're going to go through how depreciation works, because it is the most misunderstood wealth building factor in real estate. And we'll go through examples of how to supercharge returns from a directly owned rental property, and also how to supercharge your returns with depreciation on the passive fund side. So it's going to be a very interesting example, and it's something I recommend all real estate investors make sure to understand it. It took me really a year or two to understand it, and I wish I did earlier. So it's a very, very powerful concept. And on that Monday before, we are doing a special webinar on Ironton to really talk about more of the Fund for Growth, NDF, and the other fund at Ironton, which is short-term income, which is more of a liquid, pay you, 7-8% annual returns. So come learn about those so you can do some better modeling with your properties and also understand how those types of investments may be a fit for your investing strategy and your portfolio. Again, if you can't make those, register for them. If you get lost or confused, email me or the team. We'll definitely point you the right direction. Lots of webinars, lots of links. It gets confusing, so don't be shy with anything. So looking at all this, I don't see any more questions coming here. Lots of thanks and thumbs up. So great job. Panel, Jenny, Lon, Nicole, thank you guys as always. Attendees, we appreciate your time, and we look forward to seeing you next week. Bye, everyone.
Thanks, Chris. Appreciate it, everybody. Thank you.